Hi, this is Derek Hodges of Anchor Point Wealth Management. In the last few weeks, growing fear of higher interest rates coincided with a 12% correction in the stock market, which quickly recovered most of what was lost. And in this period of increased volatility, the financial press often stoked the fear. While no one can predict the stock market's near-term ups and downs, what we do know is that history shows rising rates are not bad for stocks. Rising bond yields have actually often coincided with bull markets in stocks. The red arrows point to 5 periods since the 1990s when the yield on 10-year Treasury bonds rose sharply and stock prices rose at the same time. The key to understanding how stock prices and rates can rise at the same time is in the yield curve, the differential between long-term bond yields and short-term interest rates. When the yield curve is inverted, when short-term interest rates are higher than long-term bond yields, that has been bad for our economy. Before each of the last 3 recessions, the yield curve went into negative territory. Currently, the yield curve isn't near inversion. It's not signaling an end to an 8.5-year-old expansion and the bull market. Economic growth is manifested in the profits of publicly held companies and largely determines how stocks are valued. In just the past 2 weeks, profit expectations for America's largest publicly held companies grew sharply. Fritz Meyer, our independent economist, has reported a pattern of repeated upward revisions to already booming profit forecasts since the new tax law was signed. The average company in the S&P 500 was expected to earn $131 a share in 2018 when the tax law was signed on December 22nd. By mid-February, that was revised upward to $157.47 and could be boosted again. Historically, profits at S&P 500 companies have grown 7.4% annually over recent decades, powering an average annual return of 7.4%. 7.4% pales in comparison to the 19% growth in profits expected in 2018. Another sign of economic strength came in last week's report of U.S. leading indicators. This forward-looking composite measures 10 indexes of economic activity, and it strengthened by 1% in January to 108.1. That followed months of increases in 2017, and the LEI is higher than it has been since 1999. This 105-month-old economic expansion is approaching the length of the longest expansion, the 120-month cycle in the 1990s, and it's still got legs. Don't be distracted by the financial media's short-term outlook and stay focused on the long term. Please contact us with any questions or to set up a meeting, and don't hesitate to share this video with people who might benefit from our work.